Good afternoon, everyone, and thank you so much for joining us today. My name is Sarah Krapek, and I'm the Director of Participant Education with Strategic Retirement Partners. All the lines will be muted during today's call, but if you do have questions, please feel free to enter them via the chat feature, and we will do our best to address both some of them throughout the webinar and then some at the end as well, just as best we can. Should we reach capacity here on our live session on Zoom, then additional participants will be invited to join us via a live stream on Facebook. So you just accept that invitation by clicking on the link to go over to SRP's Facebook page. And please be assured that you do not need a Facebook password in order to join us there. Speaking of Facebook, we would love to connect with you there. Please visit our page, like and follow SRP to get up to the minute information on retirement savings and other important planning topics. In our reminder for today's session, we did point you toward SRP's Roth flyer. So hopefully many of you were able to access that on the SRP blog. But if not, I will post a message during today's section with a link to that so that you can access it as an important reference tool that goes hand in hand with our topic today. And now, without further ado, I am pleased to introduce my colleague and our speaker for today's session. You see her here. This is Jeannie Fisher. Jeannie is a CFP and a CPFA with Strategic Retirement Partners based in Nashville. Over the past decade, Jeannie has built a successful practice serving as an investment advisor representative and financial consultant for both families and businesses. Lucky for us today, Jeannie's goal is to simplify advice in an overly complicated, often jargon-filled industry. She has served as a resource for numerous national publications, including Forbes magazine, Time magazine, USA Today, CNBC News, and US News. She's been interviewed on NPR's Here and Now, Women Rocking Wall Street, and Dough Roller. She's a regular contributor to 401k Specialist magazine and HR Professionals magazine. And Jeannie is well known for her creative social media content within the retirement planning industry. So with all that said, we are thrilled to have you with us today, Jeannie, and I will pass the baton. Take it away.
Thank you. Thank you so much, Sarah. I'm really excited. If I had a soapbox topic, we just stumbled upon it. So I'll try to make the Roth conversation as riveting as I possibly can for everybody that's out there. The good news is this should be relatively short, and we've designed this to allow for questions. So please use the chat feature, circle back with your SRP Managing Director after this. We want to make sure that you leave with a well-rounded understanding of what the Roth is. So I had a wonderful introduction from Sarah, but I do just want to flash up if you have more questions about what we talk about today. I produce regular video content. It's about 3 to 4 minutes, often just hitting on a specific financial planning topic. So please feel free to follow me on all the social media networks and look back at some of the previous content created. So let's walk right in to what is a Roth. And I could get really boring and explain that it was named after Senator Roth when he created it in 1997, but I won't take you all down that path. I do want to emphasize one primary thing for today, and that is there is a difference between a Roth IRA, which was founded in 97, and the Roth 401k, which really didn't come about until 2006. And it may shock all of you that that was more than 15 years ago, but still relatively new in this 401k space. So we tend to get a lot of questions about what does it even look like? So when we speak to our participants, we often say when it comes to your retirement plan, you have 3 basic decisions to make. The first is, how much do I want to save? The second is, how do I want that money invested? And then the third and final is, how do I want my retirement account taxed? Now, 7 out of 10 retirement plans out there offer a Roth inside the 401k. And we think very soon it will be 100%. In fact, I've done a presentation naming the top 10 signs that your retirement plan is aging And the number one was those retirement plans that do not offer the Roth. So it is sweeping from a plan design perspective. However, we find that a very small percentage of our participants are actually taking advantage of it. And we think that's because many don't understand it. So the first just overarching questions we get are, do I need to open up another account? Or do the investments differ? Well, in reality, if your plan offers the Roth, it will be inside the current account. And when you go to enroll or change your contributions online, you would have the option of a pre-tax deferral or a Roth. So it all should be built into your existing plan. So back to the basics. What is a Roth? It is different from what you are used to with the traditional 401k. And again, this is your opportunity to decide how you want your retirement account taxed. If you elect a Roth deferral, you are foregoing the tax deduction today. You are saying, I'm not going to take this as a tax deduction. I just want to save my money. When you do this inside a Roth 401k, assuming you follow all of the rules and you make a qualified distribution, then that account can grow tax-free. And then when you go to take the balance out in retirement, you can take it all out tax-free, assuming it's a qualified distribution. So how does this compare to the traditional 401k? Well, on the left side, if you're making a pre-tax deferral, you're going to take a tax deduction today. The account will grow tax deferred if you follow all of the rules and you make for a qualified distribution. But when you go to take the money out in retirement, you will report it as taxable income. If you go the Roth route, again, you're foregoing that tax deduction today, it grows tax deferred, and if you follow all of the qualifying rules, you can have a tax-free distribution. So the biggest difference is, with the traditional, you're paying taxes at the end, after growth. And with the Roth, you are paying taxes in the beginning and not paying them at the end. Okay, so that's the basic understanding. Let's make it a little bit simpler. If you are a farmer and you are buying seeds to then plant and grow into corn, would you rather pay tax on the seed or the harvest? And the understanding behind that example is we would expect the harvest to be valued at so much more than just the seed. And that's really how we want to look at these retirement vehicles. Now, if you're sitting there saying, I don't know that I had the option, or I don't know what I did, or I don't remember what I chose, it's possible that you were auto-enrolled into your retirement plan. And if that was the case, you were probably auto-enrolled in the pre-tax model because that's how most are designed today. This is certainly something that you could go back and revisit by logging into your account online or by consulting with your SRP advisor or your HR. So we'll stop here and we'll go ahead and hit some common Roth questions or misconceptions because we tend to get a lot of questions here. The first thing that I tend to hear is, do I make too much money to contribute to the Roth 401k? And the answer to that is no. This is a primary difference between the IRA and the Roth 401k. Sorry, the Roth IRA and the Roth 401k. There is an income limitation on the Roth IRA, which is the general knowledge that we hear from people. There is not an income limitation on the Roth 401k, and we will show you those numbers in the next slide. Secondly, is it too late for me to start saving in the Roth? If the real value of the Roth is all of that potential for tax-free growth, have I already missed the boat? Well, this is a loaded question because there's a yes and no answer. You do want to pay attention to when you intend to distribute or take money from the account. There is a 5-year rule on the Roth where you could lose some of the tax advantages if you intend to take the money out in 5 years. So yes, if this is an account you're looking to actually distribute from pretty soon, you may be too late. However, if you have any reasonable amount of time for that money to grow, then I may argue you're not too late. And there's other considerations there's other things you want to take into consideration too. Can I save pre-tax and after tax? And this is a question we get when people are interested in the Roth. They like the idea, but they're a little bit hesitant to jump in feet first. Most plans will allow you to split your deferral. So you would be able to log in, let's say you were saving 6%, maybe you want to do 3% pre-tax and 3% Roth. Most plans are actually going to allow you to do that. And then will my employer match my Roth? Yes. You will still get your employer match. Now, here's what you want to remember about your employer match is your employer's taking a tax deduction for that. And that money will be saved in the traditional way, where it will grow tax deferred and assuming you meet all the qualified distribution rules. When you distribute that portion of your retirement plan, it could be taxable in retirement. So if you are electing to make your employee contribution a Roth, and then you're getting an employer match, you should see two different lines, either in your online account or on your statement, one that says, employee Roth, and another line that says, employer match. And they will be coded differently for tax purposes. So we hit the high level of just what a Roth is. I will pause here for just a second, Sarah, and just make sure we don't have any questions that you think we should go ahead and address.
Yeah, Jeannie, we have a few questions that have come in. So if you don't mind, we'll address them just here as soon as possible. Most simply, it says, if I want to sign up for a Roth 401k, how would I go about doing that? So if someone wants to take action, what do they have to do?
So we need to make sure your plan allows for it. And again, about 7 out of 10 do. So there's odds are that it does. But when you go to enroll online, you should see where your deferral options are, a pre-tax or a Roth option. If you don't see the Roth option there in the deferral box, then speak with your HR.
Okay, and this one comes from David. It says, don't we expect that in retirement we will have a lower tax rate, making it better to pay taxes at the end as with a traditional 401k?
Probably the number one question we get, and it's a fair question because we will consider tax rates. What we really want to emphasize here is the potential for tax-free growth. And I'll walk through some scenarios a little bit later to really emphasize that difference. And then you can weigh financially your tax rate today versus your tax rate in retirement, as opposed to the keyword I'm going to share, the taxable base, because that's what's different.
Okay, and then how about one more and we'll move on. This says, if I am just starting out in my career and thus just starting a 401k for the very first time, is Roth suggested?
Yes. So if you're just starting out, I'm going to make an assumption that you're younger. And one of the things that I really advise is the Roth is very beneficial the longer it's invested. So that means it's more beneficial the younger you are. The other plus side is if you're just getting started out, you're not used to the tax deduction that others have been getting with the traditional. So it may not feel as painful because you're not even used to the tax deduction.
Okay. All right, very good. We have more questions rolling in, but I'm going to read them and let you move on, Jeannie. We'll come back later with some more, okay?
Okay. So I'm going to show some slides with numbers. Don't get overwhelmed. I'll walk you through them. They're not too much, but just things that we need to visit. So we talked about how there is a difference between a Roth IRA and a Roth 401k. So if you look at this screen on the left-hand side, those are the income limits. And if that doesn't make sense to you, that just means if you earn a certain amount of money, you're not eligible for the Roth IRA, which is why many people ask, don't I make too much money? And that could be the case. You may earn too much money. If you're married and you earn more than $196,000 a year, you're not eligible for the Roth IRA. But notice down at the bottom in yellow, there is none for the Roth 401k. So if you're a high income earner and you're interested in this strategy, the 401k could be a place for you to save these Roth dollars. Another big differentiator between the two accounts is how much you can actually contribute. So you can contribute $6,000 or $7,000 if you're over a certain age into the IRAs. But with the 401k limits, they're higher and you get the same higher limit just like you would in a traditional 401k. So for those under 50, it's close to $20,000 a year. If you're over 50, it could be $26,000 a year that you can actually save in Roth dollars into your retirement plan. Okay, so then people tend to say, but does this just mean I'm gonna owe more on my taxes later on? And here again is a key differentiator with a Roth 401k. Remember, these deferrals are processed from your paycheck, and that's where you would feel the tax difference. So here's the first thing I want you to follow on this slide. When you put in online, I want to say 6% or 5% or whatever you elect, that percentage will always be taken off of your gross paycheck. So sometimes people think that if they're doing the traditional, they're actually going to be saving more, but that's not the case. 6% into the Roth is the same dollar figure as 6% into the pre-tax. The difference is on your paycheck, instead of them taking out that contribution and then calculating your tax withholdings, they won't do that. So a 6% Roth contribution is $200, and that's the difference you're going to see on your paycheck. If you have been saving 6% in this example, in the traditional manner, you would have been saving $200, but because of the tax deduction and the adjustment to withholdings on every paycheck, it only actually cash flows out to $156. So it's not like you're going to necessarily owe more in taxes, and all of this depends on what you claim and withholdings and all of those other things. Just know that the tax change, if you're changing from one to the other, it's felt on your paycheck and with your withholdings, not necessarily later. Now, I will make one more comment about this scenario because I think it's important. This lady, Lisa, in this example, has a $40,000 income, but we are assuming a 22% effective tax rate. And I will just add the commentary that that's actually really pretty high. Prior to the Tax Cut and Jobs Act that was implemented a few years ago, the average effective federal tax rate was somewhere between 14 and 16%. And all of those basically went down with the last tax reform. So the only caveat I would say in this, as you're looking at this example, is be cognizant of your tax rate today, which is affected by a partner or anybody you may be filing jointly with. But also know that we really did err on the side of a higher tax rate in this example. Okay, so a few more questions. An example, a real life example with numbers, okay? And hopefully this will help emphasize what I really want to emphasize, which is the true value of the Roth lies in the time you have for the account to grow, okay? So this is Melissa. Melissa is a participant in an SRP retirement plan, and she is 35 years old, and she really wants to start saving, and she really wants to start saving aggressively. So she has decided to save $10,000 a year. Now, let's just say that she was auto-enrolled in her retirement plan, or she just signed up for the traditional 401k. By the time she reaches retirement, we hope with a 7% average annual return, which is a fairly conservative assumption of, putting money in your retirement plan and letting it grow every year. Hopefully by the time she's 65, Melissa is looking at a retirement plan balance of almost $1 million, right? This is why we save in our retirement plan. Save a little now, so it's a lot later, so we can have that financial independence. So Melissa starts saving in her traditional 401k, and when she reaches 65, she's going to start taking her distributions. Now, this is something we've dealt with a lot. As a certified financial planner, I've worked with a lot of retirees actually turning that big old nest egg into a paycheck. So for her, we're just going to assume that she's going to take the regular 4%, which is kind of what you hear, 4% of your nest egg, which equates to about $37,800 a year that she's going to be taking from her retirement account, all of which may be taxable if she has done the traditional this entire time, because she took the tax deduction, it grew tax deferred. Taking out her taxes in retirement, because now it's taxable, she's looking at an annual income of about $32,000. This is one of those things we constantly have to coach retirees through. If they call and say, okay, I need to take $40,000 in distributions, then we often have to coach them through the fact that it will be taxable, there would be tax withholdings, and this is how we should structure the payment. Now let's pretend that Melissa goes to an enrollment meeting and her SRP advisor is there, or somebody from the participant education team is there, and they sit down and they really talk to her about the Roth option and the ability to choose how her retirement is taxed. It would affect her paycheck today, remember, because we're ripping that tax Band-Aid off and we're not going to take the deduction today. In this example, her federal tax rate's a little over 15%. She's going to lose a $59 deduction on her paycheck in this scenario. So again, ripping that tax Band-Aid off, she's not going to be able to take that deduction. But let's go back and revisit the math of this scenario. She started saving at age 35 and she saved for 30 years. And every year she saved $10,000. So how much did she actually save herself? How much money did she actually put back? $300,000. So over the course of that time, she elected to not take a tax deduction on $300,000. And because she did that, because she ripped that Band-Aid off, her account grew to $945,000, resulting in $645,000 of tax-free base. So this goes back to that question that, well, what about if my tax rate's higher today than it's going to be in retirement? And that's a completely fair question and one you want to ask yourself and pay attention to. But remember, when we pay taxes, there's a full equation, and the tax rate is only one variable in that equation. The other variable is the taxable base. So think about how much your tax rate would have to go down to give up the benefit of $645,000 or whatever your potential growth may be in tax-free assets. Does that make sense? I mean, if I got to choose what I was going to pay tax on, I would rather pay the tax on the $300,000 than the imbalance. And that goes back to that, would you rather pay tax on the seed or the harvest? And a lot of us, if you're on this call, you are probably really interested in your finances. You take an active part. You want to know what's best for you. A lot of us on this call understand compounding interest, but tend to miss that benefit when it comes to the differentiation in taxes. Other Roth considerations, because we have really simplified the conversation here. So I want to talk about some other considerations because there's a lot of different facets to this that we want to be aware of. Notice I say, how long is your retirement horizon? So if we are speaking to, or if I'm sitting here and I'm speaking to an individual about their retirement accounts, they may say, well, I'm going to retire, in 20 years. Is that enough time? Like, is that enough time to enjoy the potential tax-free growth of the Roth? And a lot of times I'll turn the conversation and say, I understand retirement may be in 20 years, but how long do you intend to live after that? Are you anticipating distributing your entire account at age 65? Or will you actually not start distributions until 70? Or maybe you'll tap into other retirement accounts first. So horizon is important, but also not just the date you're going to retire, but in reality, when you intend to take distributions from the account matters too. And it's not unusual for some of our really high net worth clients with a whole lot of assets and great savers. Some of them come to us and say, I don't think I'll spend all of this anyway. There's a good chance some of it may go to my next generation. And that again is an extension of the horizon that we would want to consider. What is your current and predicted tax bracket? It is important, but always in the context of making sure we understand the tax-free growth. Are you eligible to contribute to a Roth IRA? It could be, if you're a high income earner, you don't have the ability really anywhere else to save these after-tax dollars. So maybe the retirement plan is the best place to do that just because you're not allowed to do it anywhere else. And then how are your other investments being taxed? So a lot of the times we get questions from older participants that say, I don't know, should I be doing it? Should I not? And one of my first questions is, well, let's take a look at your current savings. Is all of that tax deferred? Because we all understand diversification from an investment perspective, but we really like to talk about diversification from a tax perspective. I wish I could predict the government. I wish I could predict tax rates and all of those things, but unfortunately we can't. So one of the ways in our world that we just help mitigate some of that risk if we can is by diversifying. And if everything you have currently today is going to be taxable to you in retirement, maybe it does make sense to create a potentially non-taxable bucket, or vice versa. If everything else you have is after tax, maybe we should be doing some traditional today, again, just to diversify those taxes. Sarah. Oh, and one more thing. Do you intend to spend all of your retirement assets? So this is another thing. This is the final point that I'll make. Roth IRAs do not have required minimum distributions. And I emphasized IRA because there's a difference there. It's important that you note that. But for those individuals who don't intend to spend all of their retirement, or another example would be maybe you have a large pension, you know, and that pension income is going to be coming in, whatever it is, if you want flexibility over what you are forced to distribute, which is a required minimum distribution at age 72, this could potentially be another benefit of the Roth IRA because they don't have RMDs. So you really want to be looking at your cash flows in and through retirement. Okay. All right, now Sarah.
Great, thanks, Jeannie. We have a number of questions coming in that are somewhat related to one another. So I'm going to paraphrase a little bit, but if someone is over age 60, for example, planning to retire within the next 5 years or so, and have just saved 401k, you briefly commented on this, but someone specifically asked, is there no point in even starting a Roth at this point? Can you address that just a little bit further for those that might be in their pre-retiree years?
Yes. So for those of you who are asking that question, the very thing you want to answer is, when do you think you will need to take money from this account? Again, try not to focus on your retirement date. Try to focus on your distribution date. If you have enough in your traditional assets or a pension or savings to fund retirement for the first 10 years and you don't anticipate needing or tapping into this account until later, then there definitely could be some reasoning for doing the Roth.
And is there, Jeannie, an ideal balance or mix that we should be aiming for as savers as we're kind of cruising into that retirement date? If we have a bucket of Roth and a bucket of traditional, is there an amount that we should be aiming for?
You know, I don't know necessarily that I can answer that because that is going to be really contingent on each individual's taxable income. And your taxable income is influenced by so many other things that we don't even know of, namely pension income or a spouse's income. You know, if you, I will tell you this, I have done so many financial plans where people are under this assumption that they're going to be in a lower tax bracket in retirement. And then they come to us and we build cash flows and they laugh because their retirement income, once you stack a pension and Social Security on top of RMDs from your traditional IRA, it is not unusual for you to actually be in a higher tax bracket. So that percentage is really hard to peg down unless we have the full picture.
Okay, very good. Another common theme question that I'm getting a lot of is, what should we do about a conversion? If someone is convinced and sold maybe on the principles that you've discussed about Roth today, is it advisable? Should they? And how might they consider an in-plan Roth conversion?
Yes. So believe it or not, if you don't know this, 401ks can allow for an in-plan conversion. Okay. Not as many have adopted it lately, but it is a potential to do it in the plan. And then of course, if they're referencing IRAs, there's also conversion ability just between IRAs. So here's what you want to consider. Any conversion that you do, you would report as taxable income and you have to pay taxes on that. And you can't pay it from plan assets. So, if you decide to do an in-plan conversion of $10,000 from an IRA to the Roth, when you go and file your taxes, that $10,000 will be reported as income and you could owe taxes on it. So you want to be cognizant of the cash impact. Typically, when we talk to people about conversions, and honestly, it's not a terrible environment for conversions. Many people are facing repressed income right now. We are actually in a historically low federal tax rate environment with the Tax Cut Jobs Act. So it's not necessarily a bad time to evaluate this strategy, but it can have a ripple effect. So you always want to be cognizant of your next income bracket, right? Your next marginal tax bracket, and maybe look at that as a watermark. If you are older and you are really nearing Medicare age, your reported income in these years can affect what you pay in Medicare premiums. So there's more to the discussion than what meets the eye. What I like to just tell people at a high level is it's easier to stair step it in piecemeal and just do a little bit every year if you're trying to work towards that instead of trying to do one big chunk.
Okay, great. There are a number of people that have joined us today, Jeannie, that maybe don't have access as it stands right now to that Roth 401k option. There's also a gentleman on the call who is self-employed. So if someone doesn't have access to that Roth 401k in their workplace plan, what would you recommend that they do in the meantime to leverage the benefits of Roth?
So, I mean, it's a fairly easy ad if your employer is open to it. So I think that you can always reach out to your employer and say, hey, I'm actually really interested in this Roth. Can we talk about it? And in turn, they can then consult, the SRP advisor, and we can take you through that process. If for some reason your organization just doesn't want to adopt the plan feature, you can always try to do the Roth IRA outside. Now, you may not be eligible. So that's something you want to consider. There are advanced strategies. I noticed backdoor Roth was mentioned a couple times in the chat. There's some advanced strategies that may make that an option for you. If you're self-employed, you can have your own retirement plan, and especially if you're just employed by yourself, you can have a solo K with the Roth option. We do that for our our small business owners all the time. You can create the same program even if you're self-employed.
Okay, great. I think we have time for just a couple more questions here. Some good ones are rolling in, so thanks for everyone's participation. This question says, if I start saving in a Roth 401k but move to a different employer whose retirement plan does not offer that Roth option, what option do I have for these funds?
So your option would be to leave it with your current employer or to roll it. If you have a 401k that has some employer match pre-tax in your own Roth, and you decide you don't want to leave it at your old employer and you don't want to move it to the new one, you could then just roll that account to an IRA and a Roth IRA. So your rollover options are the same. And I'll give a general of thumb because I can kind of see some of the questions coming in. General of thumb, okay? Because there's always different situations, but I can make this pretty easy. I believe strongly if you are under the age of 40, that you heavily consider the Roth, all Roth. Because if you're under the age of 40, you have at least 25 years to retirement. And just the potential for growth is pretty amazing. So if you're sitting out there and you're like, I need a general rule of thumb, I think that's a good one to fall back on.
Perfect. And then this question is a little bit general, but as the Director of Education for SRP, Jeannie, I just cannot help myself. This says, do you have general advice for college students that are about to get their very first job? What type of retirement plan and investment should we be on the lookout for if we are getting ready to accept our first job offer?
So for those who are just starting out, it is not about what you earn. It is about what you save and establishing the habit day one. So the first thing you can do is just start saving, even if it's small. I do recommend you pay attention to your tax selections and you consider the Roth, especially if you're just auto-enrolled into a plan. It might be something you have to go back and actually manually change. But I will tell you, SRP retirement plans are built by some of the best retirement plan advisors out there, and they're going to have really awesome investment options. They're we believe would be really awesome investment options. If you're kind of new to the game and just kind of getting started out, there's really great things typically in plans like target date funds that are the perfect place for you. We believe the perfect place for you just to get started.
Great. There have been a number of questions that came in regarding the content today and if it will be available for a replay. And I am happy to say that we are recording the call. We're going to make it available to all of you. If you received the invitation to join this webinar, you will also be receiving the recording of the webinar today. Jeannie, just one last question because it came through a couple times. Can you give just a general explanation of what a backdoor Roth is? I know it's a big one.
Yes. Okay. So a backdoor Roth is a strategy that we can implement in financial planning. I'm going to surprise you all and explain that there is a third type of IRA out there. I know we're blowing minds. There's the traditional deductible IRA, there's the non-deductible IRA, and then there's the Roth. So the non-deductible IRA is taxed and treated pretty similar to the traditional. The only difference is it's non-deductible. And non-deductible IRAs tend to be more available because of the income limitations may not be there, particularly if your employer does not offer a retirement plan. So if you followed all of that, the backdoor Roth strategy at its most simplistic level is you contribute to a non-deductible IRA and then convert it to a Roth IRA. There are considerations. There are aggregation IRA rules that need to be considered. Also, you know, it is for all intents and purposes a loophole that wasn't intended to be there. So it is a strategy that may work for you, but it's definitely one you would want to speak with a CFP about.
Okay, perfect. Thank you, Jeannie. So it looks like we've covered most of the questions, at least those that time will allow for today. So on behalf of all of us at SRP, we want to thank our participants for joining the call today. Thank you so much, Jeannie, for your time and your expertise in preparing and delivering this session for hundreds of us on the call today. There's clearly significant interest in this topic. We will note that and hopefully bring more to you through our education efforts going forward. Now, there were a couple questions that came through the chat with regard to specific one-on-one consultation and education that you may want to seek out based on your personal circumstances. So I have a couple recommendations for that. I would contact your HR director or the person that deals with your benefits and your 401k. More than likely, that person can get you in touch with your SRP managing director and the education support that's offered to you through your retirement plan. If you need some help navigating that on SRP's side, you can email us at plantoday@srpretire.com and we can do our best to get you to the right person. I encourage all of you to once again visit our Facebook page, Strategic Retirement Partners. Look for valuable updates there regarding savings, Roth, investing, you know, navigating these times of market volatility here in 2020. There's lots of good content that we put out there, and you can certainly follow Jeannie as well. We will be sharing a recording of the session, as I mentioned earlier, so stay tuned for that. It does have to go through our compliance department, so we will be releasing that toward the end of this week. And lastly, we just encourage you to save the date for another webinar that we have coming up. It is going to be on November 10th at the same time. You'll find us here right at noon. So stay tuned for invitations and more information to come out about our final webinar in the 2020 series. On behalf of all of us at SRP, thank you again for joining us and have a wonderful afternoon.